Exchange-traded funds. Explained simply. Investing for Beginners, 2025. Welcome. Today, we're breaking down exchange-traded funds in the simplest way possible. If you're new to investing in 2025, exchange-traded funds are one of the easiest and smartest ways to grow your money. Think of them like a basket of different stocks or bonds you can buy with just one trade. They're low cost, beginner-friendly, and give you instant diversification without needing to pick individual stocks. By the end of this video, you'll understand what exchange-traded funds are, why investors love them, and how you can start using them in your own portfolio. So before we start, make sure to hit the like button and subscribe to my channel. 1. What is an ETF? An exchange-traded fund is one of the most popular investment tools for both beginners and experienced investors. At its core, an exchange-traded fund is a type of investment fund that holds a collection of assets such as stocks, bonds, commodities, or even currencies. What makes exchange-traded funds unique is that they trade on stock exchanges, just like individual company shares. This means you can buy and sell them throughout the trading day at market prices. Unlike traditional mutual funds, which are priced once per day after the market closes, exchange-traded funds provide real-time liquidity and flexibility. Most exchange-traded funds are designed to track a specific index, like the S&P 500, NASDAQ, or even international markets. But others focus on sectors, such as technology or healthcare, bonds, or commodities like gold. For beginners in 2025, exchange-traded funds represent a straightforward way to get instant diversification without the complexity of picking individual stocks. By purchasing one exchange-traded fund, you can own a slice of hundreds or even thousands of companies at once. 2. Why exchange-traded funds are popular in 2025. Over the last decade, exchange-traded funds have exploded in popularity worldwide, and 2025 marks another milestone year. According to recent financial reports, global exchange-traded fund assets have crossed $12 trillion, making them a dominant force in the investment landscape. One reason exchange-traded funds are so popular is cost efficiency. Unlike actively managed funds, which rely on expensive managers to pick stocks, most exchange-traded funds are passively managed to mirror the performance of an index. This means they typically charge much lower fees, sometimes as little as 0.03% annually. For beginners, that means more of your money stays invested instead of going to fees. Another reason for their popularity is transparency. Exchange-traded funds usually publish their holdings daily, allowing investors to see exactly what they own, unlike mutual funds, which may only report quarterly. In 2025, technology and AI-driven trading platforms have made exchange-traded funds even more accessible, with many robo-advisors automatically building diversified portfolios of exchange-traded funds tailored to your goals and risk level. 3. Types of exchange-traded funds beginners should know. While the term exchange-traded fund might sound simple, there are actually many different types designed to fit specific investment goals. The most common are stock exchange-traded funds, which track an index such as the Standard & Poor's 500 or NASDAQ 100, giving exposure to hundreds of companies at once. These are ideal for beginners looking to start with broad market exposure. Next, bond exchange-traded funds focus on government or corporate bonds and are useful for investors seeking stability and income through interest payments. Then there are commodity exchange-traded funds, which invest in physical goods like gold, silver, or oil, often chosen by investors who want to hedge against inflation or economic uncertainty. Another important category is sector exchange-traded funds, which focus on industries like technology, healthcare, or energy. For beginners, this allows you to target a specific sector without buying individual stocks. Thematic exchange. Traded funds are gaining huge popularity in 2025. These funds revolve around themes such as renewable energy, space exploration, artificial intelligence, or blockchain technology. 4. How exchange-traded funds work behind the scenes. To understand exchange-traded funds better, it's important to know how they operate behind the scenes. Exchange-traded funds are created and managed by financial institutions called issuers, such as Vanguard, BlackRock, or State Street. These issuers build the exchange-traded fund by purchasing the underlying assets, stocks, bonds, or commodities, and then package them into a single fund. Shares of this exchange-traded funds are then made available on the stock exchange. A unique mechanism called creation and redemption keeps exchange-traded funds prices aligned with their underlying assets. Authorized participants, usually large financial firms, can create new exchange-traded fund shares. When demand is high by delivering the equivalent basket of securities to the issuer. Conversely, if demand falls, they can redeem exchange-traded fund shares in exchange for the underlying assets. This process ensures that the exchange-traded fund price remains close to its net asset value. For beginners, this might sound technical, but the key takeaway is that exchange-traded funds are designed to stay fairly priced compared to the actual value of what they hold. Another advantage of exchange-traded funds is tax efficiency. 5. Benefits of investing in exchange-traded funds. Exchange-traded funds have become the cornerstone of beginner investing because they offer numerous advantages. First, they provide instant diversification. By owning one exchange-traded fund, you're investing in a whole basket of securities, which spreads risk compared to betting on a single stock. For example, a Standard & Poor's 500 exchange-traded fund gives exposure to 500 of the largest U.S. companies at once. Second, exchange-traded funds are cost-effective, with fees significantly lower than mutual funds or actively managed portfolios. This means you keep more of your returns over time. Third, exchange-traded funds are extremely liquid. You can buy or sell them anytime the market is open, unlike mutual funds, which only trade once per day. Fourth, exchange-traded funds are transparent, as they disclose their holdings regularly, often daily, so you always know where your money is invested. 6. Risks and limitations of exchange-traded funds. While exchange-traded funds offer many benefits, they're not risk-free. The first risk is market risk. If the overall market declines, so will the exchange-traded funds that track it. Even diversified exchange-traded funds can lose value during a downturn. Second, liquidity risk may arise in niche or thematic exchange-traded funds that don't trade as frequently, leading to larger spreads between buying and selling prices. Third, tracking error can occur, meaning the exchange-traded fund doesn't perfectly mirror the performance of its underlying index due to fees, trading delays, or imperfect replication. Fourth, thematic or sector exchange-traded funds carry concentration risk because they focus on a smaller group of stocks, making them more volatile. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.